Thank you, everybody, for joining us today. My name is Lauren Wells. I'm joined here today by my co-founder, Chris Seveney. We
Hey,
are
everybody.
we are Seveney Investments, and today we really want to talk about our due diligence process and what it looks like when we're evaluating assets, the process we go through before, during, and upon acquisition. And then we'll walk through some case studies. But as always, we will kick it off with an overview of who we are, what we do, and our offering so that you can kind of see that up front. Again, if you're just joining us, if you have any questions, please feel free to drop them in the Q&A. And we will go ahead and answer them as we go or keep them till the end, depending on if we can fit them into the flow of the webinar. So with that being said, we are Seveney Investments. We are a Virginia-based real estate investment company that focuses on buying and selling mortgage notes. And how we do this is we like to say we fix and flip mortgage notes. So we are investing in performing and non-performing mortgages that are secured by single-family homes throughout the US. We are increasing the value of that loan by working with the borrower, and then we flip it when we sell it back on the secondary market. So, Chris, anything to add here?
Nope.
Um, I'll let you go first, but a little bit about our
Okay.
backstory. I really feel like it's important that you guys get to know how we got here.
Yeah. Thank you, Lauren. And thank you everyone for joining us today. My backstory getting into mortgage notes has been a long journey that started almost a decade ago, where I was working the W-2 job and realized I had one of my coworkers laughed at me when he said, like, I don't own any individual real estate. I'm not investing in anything outside my 401k while I was working a full-time job in real estate. And you'll hear me say the phrase, the 40-40-40 club, where you work 40 hours a week for 40 years for 40% of your retirement. So I then realized I need to do something. And I got involved in mortgage notes in 2016. And for me, it was love at first sight because I could do it from home. I got to work in spreadsheets and just nerd out over numbers, which, being an engineer, that is my gig. And my goal was to focus on building long-term income growth for myself and my family. And we realized that not everyone had access to these types of investments as I started creating funds. So once I started raising money, we were doing all the accredited investor funds, but I had so many people that would come to me and say, Chris, do you have anything for non-accredited? I have a good job, I have money, but I'd really like to get involved in notes. And they couldn't. And that's when Lauren and I decided to do the Regulation A+ offering that allows for the accredited and non-accredited investors. So go ahead, Lauren.
So same, but different journey that I took to get to where we are today. I come from the software startup company after college. I actually did two things. I worked in software sales, and I also volunteer water polo coached at a local high school. And some of you might have heard the story already. If you're joining us for the first time, I'll tell it again. When I was volunteer coaching, I realized that this was high school age, a lot of the parents in the stands that were there, practices, games, tournaments, everything. And what I realized was, after asking myself, how can they be here at all times, every day, all day, whenever their kids have practice or games? I realized that most of them run their own business or invested in real estate or both. And so at the time I was newly married, did not have kids, knew I did want kids at some point, and wanted to be able to set ourselves up in the future. So I started using my sales commission to invest in real estate. And then from there, met Chris at a conference, virtual conference, where he was speaking. And basically, I say I LinkedIn stalked him. I sent him multiple messages on LinkedIn. He was telling basically his presentation was all about losing money in mortgage notes and how that could happen. So I naturally wanted to learn more. I liked mortgage notes. I liked that they were secured by physical real estate. And Chris and I started working together on, like he mentioned, previous funds, individual deals. And similar to what he said, really realized that there wasn't something that made this accessible, investments that were accessible and available to the masses. So what I mean by that is when I was looking at passive investments, one, I didn't know that you could invest in a fund, or I did, but I always saw it as like a 50, 25, 50, 100K minimum. And if you're just starting in investments, that's a lot to invest in, one, your first investment passively, and then two, any investment, to start. So the Reg A really came from that passion of making it both accessible to, from a minimum perspective, having a low barrier to entry so people could get used to what it was like to work with us, what this asset class looked like, what the, team looked like, how we operated, but also available. So available to both accredited and non-accredited investors. So really opening up the opportunity beyond just your ultra high net worth and family offices. So that's kind of where the Regulation A came from.
And one thing I'll just add too is I didn't start till I was in my 40s, and Lauren, you were, I think, in like your late 20s when you got started. So there's, we are very opposite where we started. So it doesn't matter whether you're, in your midlife or younger life, that this opportunity can be done in either scenario.
So with that, like our mission was really to democratize investment opportunities while providing win-win solutions to borrowers. And I know that whole phrase of democratizing investment opportunities might sound cliche, but it is cliche for a reason. And in that, everyone understands what it means. It's really making opportunities available to the masses, giving everyone a chance to play the game. And so here's our offering. I know we've already had some questions about the terms and length and lockup and minimum. So like we mentioned, it is a Regulation A offering open to accredited and non-accredited investors, meaning you don't have to have a minimum net worth or income. The term is 4 years. So your money is with us for 4 years. You can redeem early. There are specific redemption penalties should you choose to do so. Minimum investment is $5,000. However, we do start offering bonus shares at $25,000. And then we aim to provide a preferred dividend anywhere from 8 to 10%. And that really just depends on your investment amount. So those bonus shares is what increases that overall IRR. So, and that is paid monthly. So for example, investors who are to invest today by end of May, or excuse me, investors who invest by the end of May, their shares are issued June 1st and they start accruing interest, and their first dividend is July 1st. So investors who invest in May, your first dividend can be expected in July. Anything to add? Oh, here we go.
No?
Guess I kind of covered a few of these. Offering highlights. So it is available to qualified and non-qualified accounts. We work with a lot of self-directed IRA custodians. If you've worked with us or if you're interested in, you do have a self-directed IRA, please feel free to reach out to us and we can either provide you with a list of custodians we work with or let you know if you're looking to open one of some that we have worked with. Dividends, like I mentioned, are paid monthly. It is a non-correlated asset class, so it's not correlated to the stocks. It's, independent of that. Collateral coverage. So this is really important, and something that initially drew me to mortgage notes is the equity coverage of the assets that we invest in. And essentially knowing that we're into, for example, a $500,000 house for the loan, say 100K. So, there's that significant equity coverage should the market correct or, housing market drop. It is not a blind pool. We have over 93 assets. This is as of 1/1. So again, this is not our first rodeo. We're not raising capital to wait and deploy. We are constantly deploying capital into assets. We don't have any fees. So you're not going to come in and that 8%, get cut down to 5 because we're taking a management fee, a disposition, an acquisition, an account fee. So, and then really the last thing that's important and most people might not recognize or think about off the top of their head when they first start investing is the tax ramification. So this is not, you're not going to deal with the dreaded K1s. It is a 1099 dividend, and I am not a I'm not a CPA. I do not give tax advice, but I'm aware that these are treated as long-term capital gains. So there is some tax alpha. However, how that affects you, you would need to check with your individual CPA or financial advisor. But essentially, long-term capital gains are taxed at a lower threshold than your ordinary income tax.
The only other thing I'll add, Lauren, is we don't have any leverage currently within our portfolio. So when you look at the capital stack, the investors are, there at that bottom of that capital stack. It's not like other syndications you may see where they've gotten 75, 80% of a loan from a bank and 20% is the investor capital. It's right now, there is no leverage within the offering.
Quick overview on how we make money in note investing. So like I mentioned, this is that fix and flip. This is where we talk about that fix and flip, how we fix and flip mortgage notes. So we are buying loans on single family homes at a discount anywhere from 40 to 60%. And then it really goes one of two routes. For about 95% of our portfolio, we're able to negotiate a payment schedule with the borrower, which then generates profits from those payments and increases the value of the loan, making it reperforming. And then we're able to season it for another 6 to 12 months of payments and sell it as a performing asset at a higher margin, or the property is sold by the borrower or they refinance, which, as you can imagine, is not happening as much in this interest rate environment. And then for about 5% of our portfolio, should the borrower decide, we're not going to work with you, I'm never making another payment again, we can, the note is secured by the home, so we can take ownership of the home and generate profits from the sale. Now, a couple of things I want to really touch upon here. When you see this first arrow that goes to the two boxes, what we are doing when we board loans is we are sending a demand letter. And the demand letter is really the first step in the foreclosure process. Now, our intent is not to foreclose, but what it does is it really brings the borrowers to the table when they're getting a letter. And Chris, you know this, you see this all the time. When they're getting a letter from an attorney on attorney letterhead about their home and their loan, they're much more, it's the probability of them coming to the table to work with us is higher. Now, you might be thinking, my next point here is, why would a borrower decide to work with you? Now, most people don't just wake up contrary to popular belief and decide they're not going to pay their mortgage. It really comes down to some life event. And this is part of our due diligence process. And we'll talk about that a little bit later. And then, if we do go the ownership route, that isn't saying our goal is, again, not to take ownership of the property. Typically, foreclosure, investors, or the home will be sold to a third party, and we are paid off the balance of the loan plus any recoverable legal fees as well. So just kind of want to touch on those few things that sometimes people have questions about. Why would a borrower decide to work with you? And again, we'll touch on a little bit more of that in our due diligence process later.
And just to clarify, it's me dealing with the borrowers knowing the attorney demand letters work, not me getting sent a demand letter for me not paying my mortgage. I'm like, wait a second.
Yes, to clarify. So now really what a bulk of this webinar is about is our due diligence process. And we felt it was really important to discuss because a lot of questions come up that are answered by how we walk through and evaluate assets. Also, making sure that we're taking the right assets at the right price is really what sets us up for success and therefore our investors. So, Chris, I will let you go ahead and talk through this and pepper in my comments as we go.
Okay. So first step, of course, is putting in a preliminary bid on assets, which is, to step back even further, we'll get what's called a tape, which is a spreadsheet of assets. And it'll have a lot of the information about the borrower, the loan history, how many payments, the last time they paid, how much they owe, kind of an estimated property value. And we will take that information and run it through our model and create a bid based off of that number. We don't spend a penny of money during this time. So think about, putting an offer in on a house. You might look at it, you put the offer in, and then you wait for that seller to get back to you. And that is that next step of they either accept, reject, or counter. Most instances, there'll probably be some negotiations back and forth in regards to that price. And then once it does get accepted, that is the due diligence period. Like it's noted on the screen, it's kind of like an escrow period on a property where we will then request all the information on the loan. One of the major things that is so influential is that borrower conversation log. So there's a company called the servicer who is kind of the person who manages the loan for most lenders. So they keep us all compliant with all the federal regulations, and all of their phone calls are transcripted or recorded. So when a loan gets sold, if the loan was from 2013, we can see every contact that's ever been made from 2013, which allows us to then, see that story. And we'll talk about this more in a little bit on kind of what we do in that process. And then based off of that due diligence, we can either accept the offer or we might fade that bid, similar to like, oh, the roof really needs 5,000 repairs on a house as an example. You negotiate that to then closing on the loan and then signing the final contract and sending the money. Anything to add?
No. We're going to kind of get into the things I'd want to add later, so I don't want to
Yeah.
be repetitive.
So as an example, again, here is just a screenshot of a tape. And in many instances, we get to cherry pick, meaning, for example, we got a $40 million tape on Monday that we put approximately $2 million worth of bids. We don't have to buy all 40 million. We can pick and choose the ones we want. Typically, it's by value, by state. And then as it mentions, we'll bid based on a desired yield. So that really makes the interest rate on the loan agnostic in the sense of the fluctuation in interest rates today on what's going on really doesn't have any significant or meaningful impact on us, because if the loan's at 6% and we want to target 12, we'll discount that loan to get to that 12%. That loan is fixed at 6. It's not floating between 5 and 7 today, if that makes sense.
That's probably one of the top questions we get is, well, how does that work? How does it work in this interest rate environment? So I think that's important to know is we're really interest rate agnostic. We're bidding based on a specific yield that we're looking for.
Yeah. Oh, so now the 3 Ps. Do you want to start and I chime in, or go ahead?
Yeah. So I'm not going to go in order because we talked about this a little earlier. I'm going to mix it up, but we talked about earlier the person and what would cause someone to want to pay. Like, did they just wake up one day and decide, I'm not going to pay anymore? Again, that's typically not the case. So that's in the right. Yes. Thank you, Chris. The right circle, you'll see predicament. And really, this is probably if we had a secret sauce other than our team being all in-house, this is it. Servicing notes of the prior lender are typically and often overlooked. This is what we look into to see really what caused them to go into default. Was it typically it's death, divorce, job loss, or some health issue? And then what communication was put forth, by them or the lender? We've seen loans where the lender took months to get back to the borrower with a response to their financial package that the borrower had put together to get back on track. So it's not always as, clear cut as the borrower just stopped paying. They have no motivation or incentive to pay. It really is what's the situation? What predicament, happened? What happened when they went back to the bank, if they went back to the bank or the prior lender? And what was the communication? What was the outreach? Did the lender try to collect payment? Are they in legal of some sort? And we'll talk about legal on the next slide. But so really that predicament, I would say, is kind of our secret sauce. But we firmly believe that if you want someone, we share everything, because most of the time people, the quickest, how do you say it, Chris? The best way to get people to do nothing is to tell them everything, how to do it. So I would say that is probably our, the thing that we really dive into deep to make sure that there is a ability for the borrower to want to repay, and they have the, you know, there's someone that we see working that we could work with. And so really diving into those servicing notes. The other thing we look at is the property. So we're looking at title, we're looking at the structure, we're looking at the condition, the value of the property, we're verifying the value, making sure that, if the seller said it was a $1 million property and it's actually, we have agent go by and do a BPO on the property and they come back and say it's actually only worth about 700, that will allow us to, like Chris mentioned in the previous slide, fade our bid a bit because that value doesn't align with what the seller gave us on their tape. Now, it's really this whole due diligence process comes down to trust but verify. So trust what the seller gives you, but verify it. Use your vendors, verify that title, that it's actually, a first position. It's in the name of the borrower. It's not a house that's burned down. That's happened before. Make sure its actual property is still there. And again, the value, because the loan to value, that equity, that coverage is really important in what we do. And then the third thing is the person. So it's a little bit different and more nuanced than the predicament. The predicament is more what happened, what caused them to get behind, and what communication was done between them and the prior lender. The person is, what does their financial history look like prior to their predicament? What was their mortgage payment history? And then what is their criminal history? We've seen people that have filed bankruptcies, multiple times. That's someone we're probably not going to be able to work with. And we've also seen people who have criminal histories, probably not a loan we're going to take under consideration as well. So this is where doing that deep dive into the person, the property, and the predicament allow us to say, okay, we're going to fade these bids. We actually aren't going to move forward on these loans. And then on the next slide, we'll talk about the legal work that we do. So we do have attorneys in each state that we are contracted with. I think someone had asked a question about that. And we look at the legal standing and have the attorney look through everything to make sure it is kosher.
So one thing I'll just add to that too, when we look at the borrower, also we look at who, again, the person too, are they a debtor's rights attorney? We've seen loans that people are their attorneys. Well, they can represent themselves for free and fight a loan forever, which we see in some instances. Like you mentioned, we've seen 7 or 8 bankruptcies. We've seen people with, 17-page rap sheets. Those types of borrowers, we will typically pass on that loan because we won't be able to work with them. And as Lauren mentioned, as part of this due diligence, we also have that team of attorneys that will review the collateral in the state to make sure it's redeemable, meaning that we can collect on it. And also that it's in first position. For example, we see, the note, the note is the IOU. Most people, when they actually have a mortgage, don't realize that you're signing 2 documents. You're signing the note, which is the IOU, saying I'm going to pay Lauren Wells $100,000 at 6%, which is $600 a month for 30 years. And then there's the mortgage or deed of trust, depending on your state, that is really the contract that says, hey, Lauren, if you don't pay me based on the note, the property that you're buying or you're taking title to is secured now. So if, for example, you filed bankruptcy and had it wiped, well, I still have that mortgage that can secure that property. Now, some of the things we kind of see with the note is what's called a lost note affidavit. Think about if you wrote somebody a check and they lost it. Well, typically you're out of luck. Fortunately, a lot of states allow for what's called an affidavit saying, hey, this is lost. Here's a copy. It's still valid. And then the other is missing allonges, which typically missing allonges can be a huge deal, where it's the transfer of if Lauren owns a loan and sold it to me, and then I sold it to Katrina, if there's no paper trail showing Lauren gave it to me, how can I transfer it to Katrina? And this is part of due diligence that a lot of people miss, and they just think, oh, I'm just, buying, a note and not doing that due diligence. We talked about the mortgage a little bit. Things we've seen wrong with mortgages are incorrect legal description. Some people have multiple parcels, where they own, the city is broken into multiple parcels. It only has one, not the other. The assignments were recorded out of order, meaning that example I just said, where Lauren sold to me, I sold to Katrina. Well, on the files, it shows me going to Katrina and then Lauren to me. Well, that's out of order. One that I learned the lesson the hard way was a missing recorded power of attorney. About 5 years ago, a borrower was able to delay for about a year a foreclosure proceeding because the power of attorney was not recorded along with the documentation. We've also seen mortgages recorded in the wrong county. Louisiana, which is by parish, we have them recorded in that wrong parish. So all of these things, when people look to get into note investing, people just think, oh, I'm buying a note and everything looks clean. There's so many things that can go upside down. Bankruptcy, which is, again, I could talk for months on bankruptcy in regards to the difference between Chapter 7 and 13. And, are you getting crammed down, meaning they're trying to wipe out your loan? Is it secured or not? So, and then the last is, of course, statute of limitations, which is making sure the loan's still collectible. Some states, somebody hasn't paid in 10 years, you can no longer collect. So I know I went long-winded there. I apologize, but I get excited with this stuff. Go ahead, Lauren.
Oh, we do have some great questions that have come in, so I kind of want to go through those because they're specific to this part of the webinar. So the background of you, does it also include liens and delinquent taxes? Yes, that is part of this. We look at any outstanding taxes, outstanding liens, again, verifying that it is the first position lien if it says it's a first position lien. So yes, it does. Do you have any states you don't take loans in? I will say yes. It depends. Yes, in that we don't like to specifically look at loans in states like New York or New Jersey. We do have, I believe we have had a few loans in those states, but those aren't typically states we like to do business in.
Yeah, usually the Northeast and the Northwest. Question was, do we bid on variable rate loans? Rarely. I have, again, bought 600 plus loans. I may have had 3 within a portfolio. Overall, we don't have any in our current fund that are variable.
To what extent are Lauren and Chris personally involved in the due diligence process? You speak of attorneys, et cetera. How big is your network or team? And are you personally aware of each case and asset? It's funny you ask this. Very involved. Chris, I feel like your superpower is remembering every single asset and the details behind what exactly is going on. So when we mention, attorneys, agents doing the BPOs, when I say we have an in-house team, we are just getting the data reviewed. We are then taking it and reviewing it internally to make the decision. So we're just collecting the data from the attorney, from the title company, from the realtor when it comes to value, the servicing notes. And then our team is evaluating those in order to say, okay, yes, no, maybe so, with a faded bid. So, and then when it comes to the indicative bid, the initial bid, yes, very involved in that process. Again, our team is in-house. We're not outsourcing this, which kind of leads into another question that someone had about the business being very dependent on the expertise of Chris and Lauren. So I will say, yes, Chris and I've been in this business longest, but our team also comes from this industry. We have an asset management team that is familiar with notes, that has worked in the note space. So we're not, again, outsourcing this. Everything is in-house. We do have Keyman insurance on both Chris and myself. And then we do have oh my gosh, I can't think of the word right now.
Continuation plan?
Yes. 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 So, we do have this all written. And again, we are this is not our first rodeo. We have built our team purposefully around people who have experience and expertise in this asset class. And while we help lead the team, it is really a team effort.
Yeah, and I just want to touch base a little bit, kind of like you mentioned on the team and just like the asset management is we have 3 individuals at a minimum within the company that will, as part of the investment committee, review the file and make that decision as a team. So it's not just like me, and if I'm on vacation, everything stops. Like we have many people who are extremely talented in being able to bid, due diligence, manage the assets. So I just want to add that.
Yeah. And when kind of to walk through, I guess we could walk through a little bit more in depth on that due diligence process that, you do have your go, no go kind of
Yeah,
meetings. Assets are evaluated on a biweekly basis, not just for new acquisitions, but also, okay, where are these assets tracking against where we need them to be tracking? Either if the demand letter was sent, have we reached the borrower? What's the status? Are they hitting the expected benchmarks in order to achieve the anticipated return we were looking for?
yeah.
So our team is constantly proactive in evaluating our portfolio, which again, because we are in-house, allows us to move through the process quicker and smoother.
Yeah. And we're also very similar like pilots. I mean, we have a checklist for every checklist of everything to go through. We have you name it, we have an SOP for it, and it's documented, it's outlined. So that's another thing that I think really benefits the cross-training within the company.
I have 2 more questions. Are you seeing an increase in the number on the lists you receive? I'm going to go ahead, Chris.
I think that's the number of assets we're seeing. So I'll let you, I like your
Yeah.
analysis you always give.
So something I've said is last year at this time, this is the second quarter of 2023, we were seeing about, 300 million a month. Now we're looking at about 300 million assets a week to evaluate. So, and that started about Q4 and has been consistent. So really, as you have probably seen, or maybe not, credit card delinquencies are up, auto loans are up, and following that is mortgages. So we are seeing that, increased pressure on people's budgets, like the same person who asked this question brought up.
Yeah, we've especially, I mean, this past week alone, it's every time I look at my inbox, there's 30 million of non-performing this, 40 million non-performing here. So yeah, it's definitely been very consistent, but starting to see, I think, that uptick. And one thing I'll mention is we do not typically deal in commercial. So like office, retail, you can go on, Real Deal, Biz Now, see a lot of that. We're not in that. So
Yeah, someone had asked that, and I had typed the response no.
okay.
So
Okay. So here's a due diligence story that we'll share. And this one really boils down to, those 3 buckets of the P's: the person, the property, or predicament. This one boiled into the person, but also the property. This was a loan up in Massachusetts, actually not too far from where I grew up. And it was non-performing. And we had an offer accepted on this loan of $195,000. And they had a property value on that tape of a little over $300,000. And actually, my sister was the one who volunteered to also drive by and take photos along with the BPO on this. And as you can see in the photo, and it's big circled here, essentially the house is open. And if you peeked into the windows, there's no flooring, there's no nothing. So this house was not in livable condition. So based on that, what is this worth? So ironically, the house right next door, almost identical in size, so it was brand new, renovated, sold for $310,000. So the lender got their BPO from, here's a house right next door, same square footage, sold for 310. We think it's worth 310, not knowing that it had no floors, no bathroom, nothing affiliated with it. We also found out that the borrower was deceased. There was also some issues on the title report. So in this instance, and the house had been vacant since 2018. This was one that we went back to seller and say, hey, look, we're going to pass. There were just too many issues with this as part of that due diligence. And when you hear horror stories out there in the note space, people are like, oh my God, the house wasn't there or was in terrible condition. It's because they never sent anybody out to take a look at it.
Yeah, and I think it's important, we obviously, if you've been to one of our other webinars, you've seen the case studies that show the fix and flip, start to finish. But I think it's important to show the ones we pass on, because a big part of what we do comes down to this due diligence being done thoroughly every time, and knowing which notes to take on and which notes to pass on.
Yeah.
The cherry picking aspect of what we do is very important. So
Yeah. Yeah. And like you mentioned, we see so many assets. We're not in a situation or predicament of, oh my God, I have all this money, I have to get invested, where we just, raise 50 million, like for, again, I'm just going to use multifamily as an example. Oh, I've got all this money, I got to go invest it in a deal. For us, we get to cherry pick and be so selective.
yeah, so we did get some questions before we
Yep.
go to this case study.
Mhm.
When a potential investment property is a deed, so it's not the property, it's the note. Who are you negotiations with, the owner occupant or the lender? So it is the prior lender that is selling the assets. We are not negotiating with the borrower. So we're not looking at the property, we're looking at the note. Just, very nuanced but specific. So
Yeah.
it is
And
secured by the property, but we're dealing with the prior lender because we're acquiring the note.
yeah, one thing I want to mention too is it's illegal for us to even converse with the borrower. Like, we sign confidentiality, non-disclosure agreements. Like if I see my neighbor's house on a loan, I can't go over there and say, hey, I saw that you're not paying anymore, or try and, negotiate with them directly, because that is against federal law. So I just want to kind of mention that. And how are you able to get performance out of non-performing notes when the lender's bank can't? I'll answer that. Or
Okay,
do you
go
want to
ahead.
answer?
No, go ahead.
Well, a lot lenders are typically not in the business to deal with defaulted debt. They stick these in a file. They may reach out. Lauren gave an example of one where in the file, they asked the borrower for some financial information. Their systems only allow it's going to be within 90 days. And internally, it took them more than 90 days to pass it around everybody in their department. So by the time it gets to the last person, it's too old. And you go in this cycle. I'll use an example that during COVID, one of the largest institutions in the country could not determine, because they're still using systems from the 90s and 2000s, whether or not they could even pursue a foreclosure or not on their loans. So, banks are very good at lending money and getting the payments when they're performing. Once it goes off kilter, they struggle.
Yeah, and also, I mean, maybe you just said this, but I was looking at another
Yeah.
question that came in about how
Mhm.
when borrowers get behind, even if they had, say, a health issue and they come back to the table, the bank will say, great, you have to now, they're inflexible, notoriously inflexible in that, hey, you're 30,000 in arrears, but you can still make your monthly. That's great, but we're going to apply it to your past due in arrears. And it becomes this snowball of where it just there's no hope of that person getting caught up.
Yeah.
So, like Chris mentioned, great at creating debt. That is what they are good at. Managing it, being flexible, not so much. So I think that's probably the biggest misconception is, well, why would they pay? But if I can even further elaborate on that, you're looking at this economic climate. This isn't 2008. People are not underwater. They have equity in their home. There's no inventory when it comes to housing. Rental rates are through the roof. So borrowers are highly incentivized to work with us. And then there's also an emotional attachment that comes with their home and staying in their home. My husband and I are looking at trying to get another home here, and I'm like, I can't sell our first home. It's where my kids took their first steps. Was the first place we had together. So I think there's also emotional attachment that goes into it, again, coupled with the lack of inventory, skyrocketing rental rates throughout the country that we're seeing.
Yeah. And one last thing I'll just add to that too. If you've ever had to go to a bank and ask them or get somebody to make a decision on anything, how many people does it have to go through? Now think about how, that's on like a simple thing. Think about it on a defaulted loan. For us, we can make that decision in 5 minutes. We have an asset management team, operations manager. We know going in where we need to be, and we can literally negotiate something in 10 minutes with a borrower where a bank will take 10 months. So we'll hit some of these other questions. I think let me go through this case study, Lauren, and then we can answer the rest of these questions.
Definitely.
So this next one is up in Maine, which for anybody who's ever invested in notes, if you're on this conference, Maine is a very unique state where they have some very unique case law called the Greenleaf case. And when we were doing due diligence on this loan, we actually had to do diligence and we're ready to pull the trigger, but we had to wait until the lender got through the issues of the title, because long story short, in Greenleaf, there's probably a lot of people right now that don't have to pay their mortgage and could get a free house, believe it or not. But so understanding the laws in the state are so important because of case law from 2008 crisis that Maine came out with this opinion from their Supreme Court. So prior to acquisition, we knew the title issue needed to be resolved. And we were working with the seller and said, hey, look, title issues or title claims, a quiet title is what it's called, is an actual lawsuit. It can take 3 months, it can take a year. So we weren't going to put $80,000 out the door, knowing that we had to wait until the lawsuit got finished, so then we could go proceed with the borrower. So we negotiate with the seller and say, hey, look, we'll buy it for this amount, assuming that, taxes and everything, don't continue to increase, but we're just going to pause until you're ready to get the lawsuit completed. And then that's what we did, is we acquired it once the title resolution through quiet title was resolved. Then that allowed us to, like Lauren mentioned previously, allowed us to send the demand letter. It was like a 6 or 7 month hold period for them, that quiet title period. Now, when you think about time is money in note investing, $80,000 at, I'm just going to say a number 10%, that's $8,000 a year. That would be $4,000 of lost costs that you couldn't do anything, plus servicing and everything else of that loan. And what it allowed us to do is we did file foreclosure with the borrower against the borrower, and that kicked on the mediation with the borrower, which allowed us to, again, know the rules of, in Maine, you can get what's called HAF funds, which is housing assistance funding. And we ended up getting $50,000 from the borrower in January because we worked with them to get the HAF funds. I also learned a lot about how goats can be used as service animals as well to work around the farm based on the negotiations of the mediation, which are sometimes unique. But this is a great case study of using an attorney, spending $200 to have an attorney review the file, to tell you, hey, make sure, is this, because I'm not an attorney. I know of Greenleaf, but I don't know, is this or is this not compliant with Greenleaf? Mr. and Mrs. Attorney, can you review this and let me know, is this compliant with Greenleaf, what we need to do or the next steps? And they got on the phone with them. They walked us through the entire process and explained it to us. Then we could easily explain that to the seller as part of due diligence and wait to pull the trigger.
So quite a few questions on that kind of alignment with what makes it illegal to talk to owners directly, and then after you get the note, then how do you start contact with the borrower? So essentially it is because speaking with the borrower as a lender is considered debt collection.
Yeah.
So
can I jump in real quick? I just want to be clear. Before you buy the note, it's definitely illegal. After you buy it, you should be licensed. So I just wanted to make that clarification too.
Yeah, so there's something called the CFPB, which I always feel like sounds like a superhero agency, but it's Consumer Financial Protection Bureau. And so there are certain regulations when it comes to speaking with borrowers. Once you acquire the loan, you have to either be licensed as a debt collector in specific states. Even if you aren't working with a servicer, will still require you to be licensed. But we have licensed servicers. So that servicers are the ones who collect the financial package from the borrower And then we evaluate, we make the decisions, and we tell the servicer, hey, go back to them with this. So we are not directly calling Mr. Borrower up right away. This is all done through licensed servicers to stay compliant.
I'll just add while you look up, there's so many nuanced laws of like what times you can talk to people, call them. If Lauren's on the loan and her husband isn't, and her husband answers the phone, like I can't say anything about to the husband. So there's so many ways. There's the he said, she said of you talk to the borrower and they tell an attorney, well, this is what they said, and there's no documentation of it. So it's just so much easier and safe harbor to have that servicer handle it.
So let me, okay. How do you find people who go and view property in person, or do you just rely on Zillow and the like? No.
No.
So, yeah. No, we definitely have actual feet on the ground eyeballs. Typically it could be another, if we're acquiring an asset in a county, state area that we already have assets, we have realtors we can reach out to. You know, it's not that hard to find realtors in the area who will get you a BPO. Zillow is, you know, you can look at that from a high level, but it's definitely important that we get eyes on the actual asset, like we showed you in that prior case study.
There's nationwide companies that provide that type of service where they have networks of providing you that type of service that we use. Question is, a business like yours always has imbalance of funds raised from investors or vetted opportunities. What has been your experience? Kind of like Lauren mentioned, we are seeing hundreds of millions of dollars at a time. And, you know, Lauren and, you know, and our team has done a good job educating investors and raising money for the fund. And that, you know, once that money comes in the door, it is rapidly deployed into new opportunities. We have not had any issues, concerns with deployment of funds to date. Now, I do have to give the stipulation, past performance is not indicative of future success, but based off of the size of our fund, where we're at, and the opportunities we're seeing, which if anything, they're only going to increase, not decrease. For us, that has not been a challenge or issue.
What is your targeted ROI on the acquisition of a loan? So someone else asked about this, and I typed an answer about, like, someone asked about, well, how do you make money? Most people make it through, most fund managers and sponsors make it through their fees. So our money is made on the upside. So when we are evaluating assets for non-performing, we're bidding based on a projected yield of anywhere from 24% plus. For performing loans, we're looking at a 12 to 15% yield. So after investors are paid, expenses are paid, fees, you know, due diligence fees, like wrap all of that in, Seveney gets the upside. So that is where we make our money. We like to say we don't win until investors win, unless investors win. Actually, it's a better way of saying that. I'm not seeing any other questions. I know this was probably a lot of information as far as our due diligence process goes and what that looks like. If you have any questions, please feel free to contact us. You can reach us at invest@seveneyinvestments.com or take our number down here. You can see 866-226-5736. Schedule a call with a member of our team. Again, any other questions that might come up. And as always, I always put this out there at the end of every webinar. If there is something you want to hear more about, you want more case studies, or you have an idea for, you know, future webinar topics, please email us. You know, we don't just do these webinars for us. They're really for you, whether it's from an educational perspective or a, you know, about the fund specifically. So thank you all for joining us today. And again, any questions, feel free to reach out to our team.
Thank you all.